Times Influence Initiative.
Hello and welcome to NSE Prosperous India, a unique investor education initiative brought to you by the National Stock Exchange of India and Times Network. Now, in this special series, we are meeting people from different age groups and talking to them about some of their goals, some of their dreams, and how to match those dreams with some money which is required to fulfill those dreams. And on every episode, we bring on board a very special personal finance expert. Today, I'm joined by Nikunj Sharma. Nikunj, hi. Thanks for coming on the show. And on the episode, we have two very special guests. They are first jobbers. You know, it's that exciting time in life. You've got your first paycheck. You really want to splurge, but how do you manage the saving, the investment and the expenses? So introducing them, first up we have Priyansha. Hi Priyansha, welcome to the show. And we have Aman. Hi Aman.
Hi.
Aman, first up, tell us a little bit about yourself.
I'm born and brought up in Calcutta. I did my graduation from Calcutta itself. Then I did my MBA in marketing. And now for the last, I think 11 and a half months, I've been working in Scatter. It's a content marketing startup.
Okay. And Priyansha, tell us a little bit about yourself.
For my graduation, I did English Honours from Jadavpur University in Kolkata, and then I did an MBA in marketing. Currently, I'm working for HDFC Life in the marketing team.
Super. Nikunj, I'm sure they have quite a few questions for you, but before we go on to them, how do you guide them that this is also in fact the right time and the perfect time to start planning for your future finances?
I think it's very, very important to save for our financial goals. Generally, when we start earning, the world of money is stranger to us. We've not been taught enough about managing our money, saving it. So most of us are unaware about how things are going to pan out. As per one statistics in India, about only 2% of the people have documented their financial plans. So people don't know where I'm going to. If you don't have a plan, you're shooting in the dark. You're taking blind shots at your target. So I believe first check is okay. You are allowed to splurge the first one. Second one, yes, we should start planning. You should find a good financial advisor who can tell you about the universe of financial instruments which are available, the goals which you will have in your future, and how likely that path is going to be to achieving those goals.
But Nikunj, first up, I'll be the devil's advocate. So why financial advisor? You've got parents, you've got family, you've got friends, you've got mostly you've got elder siblings who've already started this journey. So why do I need a financial advisor?
See, my belief is that there are certain fields in which our expertise is always limited. Let's say I'm driving in a car and my steering is bobbling. I get down and see my rear tire is flattened out. So I just take out the jack, change the tire and move on. But imagine a second case where there's a smoke coming out from the bonnet. I pick up the hood and see the smoke is now coming out of engine. So what do? Will I take the panna out of dicky and open the head of the engine? No. So our expertise has a limitation, number one. Second thing which to my mind is very, very important to understand is our financial goals are very important to us. We cannot have a hit and trial way to achieving them. We can't afford large deviations. So these things are very important. It's something which is very important in our life. I need professional guidance.
Right.
The rule is very, very simple. So if I want to be a good cricket player, I need a Ramakant Achrekar.
Very true. So let's go on to them. Priyansha, what's on your mind? What are some of the major questions that you have in life?
I do have a certain amount of savings now in the few months that I've worked, but I would not know where to invest that money. So there are some terms that we've heard: equity market, low risk, high risk, you're young, you can afford to take risk.
Yes.
Then there's always the question of tax deductions, filing for taxes. I'm not really clear on the path. There are people I've asked, which is why I've taken some of the decisions that I have, but there's no way of knowing if those are the best decisions I've ever taken.
Interesting. Nikunj, your guidance?
Yeah. See, Priyansha, first of all, we should know the beginning point is our financial goal. Why should we save? So everyone would have typically an idea: when I'm going to get married. After you get married, you'll have children. Children will go to school. They'll grow up. They'll get married. You'll buy a house. You want to go on vacations. You want to accumulate certain assets during your lifetime. And then the most important goal is retirement. So first, very simple step is to write down on a piece of paper when I will need money and which are the most important goals which will consume bulk of the money. Buying a real estate is a big decision, retirement is a big decision, marriage of kids, it will require a lot of money. So first step is you list down all your goals, write them on paper, and you would know, so in 10 years time I need 5 lakh rupees, in 15 years I need this thing. Then they would be go to a financial advisor who will give you the probable routes to reach that goal, because there can be multiple goals. I can achieve a goal in 3 or 4 ways. So what route is mutually convenient depending on the kind of risk that you want to take would be suggested. So think of financial planning like a bridge. So on one side you have your resources, your money, your resources, your assets. On the other side you have your goals. So anything which is linking to this is called financial planning. It's a very simple and enjoyable process.
Aman, what's on your mind? Some of the questions that you want to ask?
I want to understand that if I work for the next 40 years, for example, by the time I retire, I would want to be in a position where my money works for me, like where I can get everything I want to do after working for so long, but not worry about money. So any direction of that?
See, typically we have 4 investment avenues. One is bonds, where we lend our money to an institution where I'm getting a fixed income. Second is equity, which is typically known as share market. So you can invest in market directly, you can invest through mutual funds. Then there is gold and real estate. Gold and real estate are called alternate assets. Each asset plays a different role in my life. I need real assets for real use in my life. I stay in a home, I wear jewelry when I go to weddings. Debt plays a role for my short-term commitments. Typically the rule is that next couple of years expenditure should be parked safely into a debt fund or a deposit or anything which is tax efficient. Equity plays 2 roles in my life. One is addressing my aspirations and second is creation of wealth. So these 2 things will be done by equity. So depending on for what purpose we are saving or investing, a particular asset class will be chosen. Each asset class also has its risk and return spectrum. Debt is considered to be low risk, low return. Equity is considered to be high risk, high return. Typically real estate and gold we consider medium risk, medium return.
Nikunj, one other point comes up is you spoke earlier about the fact that real estate is a major goal, retirement is a major goal. But I'm sure both of them will be thinking, why am I retiring? When the first year of our job, why am I even thinking of the hour of retirement right now?
Yes. I think it is a very relevant question, I would say. Nobody would think of retiring in the first year or maybe even in first 5 years. One depends on the job. Second, it also depends on when do you want to retire. Retirement is a state of mind. So I say you can retire at 40 if you have managed your money well. You can't even retire at 90 if you have not done your homework right. So retirement to my mind is a state of mind, and it represents the degree of financial freedom that we've been able to achieve up to a certain age. So thinking about all the goals, there is one rule in the industry that start early, because when you're starting early, let's say you're looking at a hill in the distance. So when you're looking at a hill from 20 kilometers, it looks only this much high. But once you reach nearer, it looks higher and higher. So it is better that we start planning early for the goals, especially which are longer term into the future, because that you will need smaller amounts.
Nikunj, I'll take a step back. When we were talking about the different asset classes, a common question that comes up about mutual funds is, where does mutual funds fit in? Which asset class is mutual funds? How can I invest? Why must I invest in mutual funds? How do you address this query?
See, mutual fund in itself is not an instrument, I would say. It's a facility which has been given by certain institutions to us. On one hand, I have my money. On the other hand, we have various securities. These could be debt market securities, equity securities like shares. It could be real estate securities. Mutual funds are basically a pool of money which is collected from smaller investors, and depending on their risk profile and investment objectives, they are taking this money to the suitable asset classes. Now this money is managed by experts. Experts, when I say experts, not that they will not do mistakes, but experienced people in this field. So what happens is, when your money is being handled by somebody who knows that field, your risk goes down. In investment, it is very, very important to keep your risk down whenever you are investing, because anyone can increase the risk and increase the return. The trick is keep your risk under control and optimize your return. So when a professional is handling my money, or when a professional was handling my car, my risk was coming down. When the risk comes down, especially in asset classes like equity, the quotient of fear will come down. When fear comes down, I will stay invested for a longer period. So mutual funds, to my mind, are excellent vehicle. They are excellent way to participate in the growth of this country and participate in our securities market.
On that note, it's time for a very short break. Don't go anywhere. You're watching NSE Prosperous India, brought to you by the National Stock Exchange and Times Network. We'll be right back. Welcome back. You're watching NSE Prosperous India, a very special initiative presented to you by the National Stock Exchange and Times Network. I'm in conversation with Nikunj Sharma and two very special first jobbers who we're guiding on the best way for them to ensure a financially secure future. Priyansha, do you have any thoughts?
Is saving the same as investing, or if I'm saving 10x, should I invest 5x and let the remaining 5x rest in my bank account for some emergency fund or just for later use?
See, the major difference, the basic difference between saving and investing is saving, you are not looking to grow your money. You're not looking to earn returns on that money. So you go to a bank and say, boss, saving bank deposit will give me 4%, 5%, liquid fund will give me 5-6% and I'll put there. In investing, you're taking a risk on an asset class. You're investing in gold. So you're given your money, the jeweler gives you jewelry. You buy real estate, you've given money to the builder, you got a... When you're buying equity, you've paid money and you've got part ownership in that company. So in investing, you're taking a call on that particular asset class. Why saving and investing is necessary? Saving is necessary for my near-term goals. Let's say I'm looking to spend some money 1 year down the line. Then I don't want to experiment with that money. If that money is there, I'll just keep it safe. But let us say there's a goal which is 20 years down the line. Let's say retirement. Now, if I want to really retire in style and say I want to have 100 crores when I retire, saving instruments are not going to take me there, because saving instruments, the return potential is very, very low. Debt, they are typically debt instruments. Debt is low risk, low return. So your shorter term goals, debt; longer term goals, equity; medium term goals, we could use a combination of debt and equity. There are a lot of hybrid products which are there in the industry.
Aman's a big football buff. So Aman, tell us about your aim.
So like he was saying that while I do want to invest for my retirement, but I also want to invest and gain the benefit out of it in the short term. So one of the goals I have is going for the World Cup in 2022.
Right.
And funding everything myself, having going for like a month-long sort of thing.
Yeah.
And I really like watching football, so I want to go and experience it live. So how can I plan towards that? Like, what would be the investment medium there?
Yeah. Let us say the World Cup will come in 2022. We have 3 years. Typically, an advisor will suggest you that we should use hybrid products for 3-year time period, and there are various products available. I will not go into details of this thing, because the time period is 3 years. We can take little bit of risk, so we can have 40-50% of equity. This is so that we benefit from the in case there's upsurge in the market, we benefit from that. If you start planning well in advance, you will not only reach that goal easily, but also it will make a difference whether you want to see the World Cup and stay in a 5-star hotel or in a YMCA hostel. So that is the difference good investing can make. And that's where I always believe that professionals, if you can tag along with a professional early on in your journey, it will be really, really helpful for you.
But next question, Nikunj, then where do you get such a professional? How do they find this professional?
See, there are a lot of independent financial advisors. The last count, we have close to 1.5 lakh independent financial advisors. Most of the banks are providing advisory and distribution services. They have teams who do product research and then they come out with their recommendations. So there are a lot of people. Ideally, you could start with 2 people, and over a period of time, as you get to know them better, you would know where bulk of my money could go. If there are 2 or 3 people, then risk is also divided. But there are a lot of people available. You could ask your banker, you could go to a mutual fund house and ask them. They will guide to the nearby and qualified independent financial advisors. There are lots of them.
Priyansha, you had a question.
Yes, so if I'm looking for an independent financial advisor, then what credentials should he or she have to be able to help me?
See, first credentials are your educational background and the regulatory exams which you need to clear to become, say, an agent or a distributor or a registered investment advisor. That's number one. Second is the experience which he has. More the number of years he has spent advising people, the better it is. Third is if he could provide you references. Like, I've been managing money of this family, you could go and meet them and this thing. So these three things are very, very important: their educational background, their experience, and some of the references which they can provide.
Is there any way in which I can see, for example, if the three people who I'm deciding between, is there any way I can understand what is the past, if all of them have been working or been in advising for the same amount of time, is there any way I can see whose performance, is there any parameter like that where I can see?
See, performance may not necessarily be a good differentiator in the short run. Let us say, one advisor gave you equity products right away, and other investor said, no sir, I will not introduce equity at this stage, but maybe we will gradually invest. So in 1 year time, you have a runaway market. So one person may show 40% return, the other guy will show only 12% return. Not necessarily the other one is bad. So performance is one of the criteria. Second criteria is how diversified your portfolio is. Third criteria is how transparent the person has been with you in terms of telling you this is what we like. Mutual fund as a product are fairly transparent. You would immediately know how much money is your distributor earning on that. He should be transparent. Fourth thing, which to my mind is very important, how is he making you learn along this journey? Is he also making you learn? Is he telling you about things, or is he hiding things from you? That will show, I think, true character of an independent financial advisor. So once you start dealing with them, it will take, I think, couple of years to figure out where you're more comfortable.
Nikunj, I want to talk to you about SIPs.
Yes.
Systematic investment plans, we've heard of it. But can you shed some more light on why is it kind of ideal for somebody who's just starting off on the first job where the incomes might not be a lot?
Yes. So SIP gives you a way to save smaller amounts and put those amounts into equity market. Generally, we advise SIP for equity funds only. Debt funds are not very volatile, so SIPs we don't advise there. So that's one, you can invest in smaller amounts. Second, is very, very convenient because you've just signed an instruction and every month the money will be debited from your bank account. Because the amounts are smaller, you don't mind the volatility of the market. You don't mind, the value going up and down because the amounts are really, really small. Over a period of time, these smaller amounts will start compounding because your base becomes slightly larger. So SIP is one of the most effective ways of participating into those asset classes which are giving you market related return. It could be gold, it could be real estate, it could be equity. Second, it also helps you in tackling the volatility of the market. A lot of people feel that volatility is also the risk. I believe volatility is not the risk. Volatility is only the opportunity, which SIP will make you fully exploit. So there is something which we call a rupee cost averaging. So when you are investing money through SIP, let's say 1 month markets have gone down, so your mutual fund units have become cheaper, you will get more units. Next month the markets are up, NAV has gone up, you will get lesser units. Over a period of time, you will get an average. SIP takes fear of loss away from your mind after a certain period of time. Most of the SIPs, if you study, I think most of the SIPs have not done any loss after 5 years.
So, well, we're just about out of time, Nikunj, but before you go, if you could guide Aman, Priyansha and all the viewers watching, 3-4 tips, 3-4 pointers that they should keep in mind as now they begin their financial journey.
I think 3 things which come to my mind, you could take them as my learnings also. First is that investing is like life, there are no shortcuts. So you will not achieve anything overnight, number 1. Number 2, I would say investing is very simple. Keep it simple, don't complicate it. There are so many things which will be out of your control. Don't worry about it. Don't worry about elections, don't worry about recessions. Do what is there in your control. So keep your investment simple. Third message which I will give is don't make money. Create wealth.
So, fantastic.
Yeah, these are my 3 messages. Yeah.
Lovely. Thank you for that, Nikunj.
Thank you very much.
Thank you, Priyansha. Thank you, Aman. I hope this was helpful to you guys.
Very helpful.
And thank you so much for watching. You've been watching NSE Prosperous India, a special initiative brought to you by the National Stock Exchange and Times Network. We'll see you next time. Thanks again. Ensuring that India's citizens are financially educated is of utmost importance for NSE. Taking cognizance of this, NSE Prosperous India continued on its journey of imbibing the right fundamental principles of investing with the members of ICT Industrial Training Institute in Delhi.
आज के सेशन से मेरे को बहुत कुछ सीखने के लिए मिला, जैसे कि एनएसई और स्टॉक एक्सचेंज और ये म्यूचुअल फंड्स वगैरह के बारे में और इन्फॉर्मेशन पता चली कि कहाँ इन्वेस्ट करना चाहिए, कैसे इन्वेस्ट करते हैं और क्या क्या रिस्क वगैरह होते हैं मार्केट्स पे।
गोल्ड में इन्वेस्ट करने से बेटर है कि आप इन निफ्टी में इन्वेस्ट करें, क्योंकि बहुत ज़्यादा लोग ट्रस्ट दिखाते हैं और वो काफ़ी ज़्यादा लोग हैं जो आपका पैसे को बहुत अच्छी जगह इन्वेस्ट करते हैं, इससे आउटपुट बहुत ही बेटर मिले आपको।
एक्सपेंसेस से पहले हमें इन्वेस्ट करना चाहिए और इन्वेस्ट ऐसी जगह करना चाहिए जहाँ पे हमें फ्यूचर में नॉर्मल से ज़्यादा सुपर प्रॉफिट मिले।
गोल्ड में या प्रॉपर्टीज़ में या इसमें इन्वेस्ट होता था और लोगों को जानकारी भी नहीं थी, लेकिन जब से ये एनएससी ने ट्रेनिंग क्लासेस शुरू करी हैं या प्रोवाइड कराई हैं, एक माहौल चेंज हुआ है, पूरे एनवायरनमेंट में चेंज हुआ है। और इनका जो सबसे प्लस पॉइंट है, इन्होंने यूथ ऑफ इंडिया को टारगेट किया है। तो क्योंकि हमारा जो यूथ है इसको ये समझ में अभी नहीं आता कि पैसा जो सैलरी मिली उसको कहाँ इन्वेस्ट करें, तो इनके लिए सबसे पहला प्लस पॉइंट यही आता है कि इन्होंने इस यूथ को टारगेट किया है जो अभी अर्निंग कर रहा है, अभी स्टार्टिंग कर रहा है और अभी से इन्वेस्टमेंट के बारे में अगर उसको सही डायरेक्शन मिल जाए तो उसका फ्यूचर सिक्योर हो जाएगा।
Times Influence Initiative.